Good morning. Welcome to Trading Hour. I am Reema Tendulkar with Mia Soneshinoy and Pavitra Parekh, and markets are grinding down. Despite a positive handover from the global markets, and US markets ended at the day's high. You had gains of about 1 to 1.5%. The markets opened flat, but since then they've been trending lower and lower. And as we speak, we're down 70 points on the Nifty. The Sensex is knocked off close to 250 points. And now the Nifty is just about 50 points away from the 26th December low of 17,774. That was a level that we were tracking closely. The 100-day moving average has been conclusively broken. We put a distance of nearly 80 points away from 17,900, and now we're 50 points away from that, the 26th December low of 17,774. And just take a look at the way India has actually underperformed the global market since the beginning of the year. And is this a sign of things to come? So year to date, the Nifty is down about 1.5%, but the Dow, the S&P 500, the Nasdaq has actually gained close to about 4.5%. Even if you compare it in the Asian market picture, where the Hang Seng is up 8%, the Japanese markets are up 1.5%, Taiwanese markets are up 4.5%. A lot of experts have been making the point that India is likely to underperform the emerging market basket, where the emerging markets are likely to make a bit of a comeback. And the flows have also not been supportive, with the FI selling in the cash market for 14 consecutive days. So just watch for India's underperformance. And today as well, India has fallen despite positive global cues. That said, today is going to be one of the most important days for this week in terms of cues. So for one, we've got the weekly options expiry. So that in itself is important. The IT sector will be in the limelight because around 4:30, 4:15, 4:30, numbers from HCL Tech and Infosys will be out. Infosys presser is at 4:30. The earnings call is at 6 p.m. HCL Tech press conference is at 6 p.m. followed by the earnings call at 7:30 p.m. and at 5:30 p.m. India's macro data will be out, and in that, the important one to track will be the December CPI. But more importantly, from a global investor point of view, it's going to be the US CPI inflation data, which will be out at 7 p.m. And does it show the trend of declining inflation, which could push the Fed towards a lower rate hike, perhaps 25 basis points in the upcoming Fed meeting on the 31st Jan to 1st of February. So this US CPI inflation print is going to be crucial for everyone. But right now, markets are trending lower.
Oh, they are. And, we were talking about this earlier in the morning as well, as to how the Nifty is vulnerable to more selling pressure purely because of the internals, right? After you broke that, when you generally test a level on the downside a couple of times, it generally tends to break. And that's what happened with the 17,900 mark. The December 26th low, I think everyone's talking about it, the 17,774 level. That's going to be a crucial support for the index. So let's see whether that holds or not. On the upside, though, I'm watching out for a couple of pockets. One of them is cement. All the cement stocks are up in the green today. In fact, JK Lakshmi Cement is up almost about 3% And I think a week or two ago, Kotak Securities put out a very interesting note where they spoke about how a lot of the raw material costs for the cement makers have been trending lower, whether it's pet coke prices, thermal coal prices have been trending lower, and that should ease their cost pressure, and hence the margins are expected to recover for this pocket in the second half of the year. So these are a couple of pockets, but through the course of the next 1 hour, we'll be talking about a slew of stocks, so don't go anywhere. Lots coming up. Pavitra, what are you looking out for?
So, like you were pointing out, the India underperformance, in fact, so much of the opinion that we got even this morning, right? Whether it's Bernstein, Goldman Sachs, IIFL, all of them sort of ringing a little bit of a tone of caution, even saying that India may lag its Asian peers because of the China reopening. So that is something that we're definitely tracking. In terms of what's doing well today, it is some of the PSU stocks. So, of course, in addition to HCL Tech, which is holding up well in the green ahead of its earnings, you're seeing the likes of Power Grid, NTPC, ONGC. These are a few of the names which are holding up better. In terms of IT, a lot of them which were holding up well, Infosys, Wipro, they have slipped quite a bit, right, from the opening level. So do keep that on your radar. Some of the smaller names, though, doing a lot better. So Persistent, LTI, Mindtree, these are still doing better amongst the IT pack. Financials are seeing another cut today. So the banks in focus, some of the larger ones are up on your screen. ICICI Bank alone has seen around 4% of a cut in 2023 so far. Bajaj Finance is the other one. It's down now almost 11% for this year. So that is definitely something that we're tracking. And Reliance also on the downside today. So that is sort of just adding to the pressure that we're seeing on the market. In terms of overnight, what went wrong, I guess it is the crude prices moving a lot higher, which is definitely a negative for India. So that is everything that we're tracking as far as the market action goes. But let's talk about a few of those individual names now. Nalco is losing in trade on the back of a downgrade coming through from Kotak. So Nigel is here with the details. Nigel, take us through the highlights of this report.
Well, that's right. Kotak has gone ahead and downgraded Nalco to sell from reduce. They've kept their fair value, though, same at around that 70-odd levels. They believe that risk-reward now is unfavorable, and they've stated three broad reasons. One, they expect range-bound earnings for the next few years, and the couple of reasons that they mention is they don't see big upside to aluminium prices. And the second factor is on the cost side for the alumina division as well. They're expecting persistent cost pressure for the next few years. The second point is they're expecting negative free cash flows for the coming years. Why is that? Because they're spending money on a new alumina refinery, which is return dilutive. So that's the other point. And finally, post the recent run-up, the point number 3 that they're highlighting is that, in fact, the stock trades at around 6.5 to around 7 times EV per EBITDA, which for a metal stock is not cheap. So put all these points together, well, Kotak has gone ahead and downgraded the stock. Back to you.
Right, thanks a lot, Nigel, for that. Well, L&T is the other stock that we're looking at. It's buzzing in trade. There are some fresh brokerage calls in case you missed out on them. Sonal is here with a complete lowdown. Sonal, what are the brokerages saying?
Well, there's a JP Morgan note on L&T, Sonia, today, and they have actually increased the target price on the stock to 2,300 rupees per share. They have an overweight rating and a positive stance on the stock as well. They say 2023 should be another year of positive returns with upside in the core business. The core PE multiples should remain cemented by continued order momentum that we have been looking at, because the company has been reporting the order wins that they have been seeing as well. Results could meet guidance in FY23 after 3 years, is what JP Morgan says about L&T. They expect robust mid-teens growth in FY24 going forward as well. There are potential in both their India and Middle East business as well, according to JP Morgan, and there are large prospects capable of swinging a favorable outcome as well, and they see continued strength in execution that could drive EPS upgrades going forward as well. Large book-to-bill and a stable working capital is something which is working for L&T as well, and that's the reason why stock is in focus today.
All right, Sonal, thanks a lot for getting us all of the highlights from this report on L&T. The next stock that we're going to talk about is Kalyani Steels. This is the one on our radar. We spoke to the management actually this morning, R.K. Goyal, MD of the company, to discuss the price and the demand situation on the ground. So let's listen in to that as well.
As such, we are under tremendous pressure. And Q4, again, we would like to have a price increase. And we have already requested some of the OEs for a price increase. Actually, our cost increase is around 6,000 rupees per metric ton. Now, we are looking for at least for this 6,000 rupees. And that's what we would like OEs to compensate. Now, this 6,000 rupees is basically the cost increase on account of direct raw material price. But whatever cost increase, we would like to get it. And if it is not, if we do not get it, then definitely there is a big impact on our profitability.
Okay, that's a very cautious Kalyani Steel, talking about how costs have gone up quite a bit to the tune of 6,000 rupees per ton, and they're looking for OEMs to compensate it. But in all likelihood, OEMs may not be able to, considering the cost pressures that they are facing. So that's the dilemma over there. But Greaves Cotton is the other company in focus. The company has launched a range of new EVs at the Auto Expo and will invest 1,500 crores in the e-mobility business. Earlier today, we had a chance to speak with the Chief Executive Officer and Managing Director, Nagesh Basavanhalli, to discuss the company's roadmap. Listen into what he had to say.
We introduced 6 new products, 3 in the two-wheeler and 3 in the three-wheeler, both in the B2B and in the B2C. So it caters to different audience, different customer segments and product segments. Regarding timing, the Primus, which is a foray into high-speed two-wheeler, the Primus will be open for bookings through our 700 odd dealer outlets in the country as of today, and it will be available in the market this quarter.
Okay, folks, the cuts are getting deeper. Look at that. The Sensex is now down 350 points, and it is turning out to be a really volatile and weak market. The texture of this market has weakened over the last many days, and we have been indicating that. But for now, it is the lowest point of trade. Let's also get you a quick update on what's happening in the world of commodities. Manisha Gupta is joining in. And today, the focus is on rubber. Manisha, what are you picking up?
Well, thank you for that, Sonia. After a very sharp decline in last few months, we finally seem to be looking at rubber prices gaining a bit. 28% of a decline is what you saw in rubber prices in 2022. But we have started this year on a slightly positive note, and so much so that the international rubber prices right now are trading at near 1-month highs. There are expectations from Chinese demand opening. That has been the case across asset classes within commodities, and rubber prices also seem to be taking support from that. The decline in US dollar index also has been supportive. And then there's a report from International Rubber Consortium which says that the production from Thailand, Malaysia and Indonesia, which are the other major producers of rubber, we have seen the rubber production decline as compared to the previous year. That has been supportive. The reasons given are leaf disease that some of these plantations are looking at, adverse weather, the rising climate temperatures does not augur well for tapping season in such, and also low fertilizer input because of the higher prices also has led to a bit of a yield decline. For the Indian markets as well, this is high peak tapping season that continues until the month of Feb. But until now, because the prices were declining, we didn't see so much of a buying coming from stockists, which also seems to be happening right now because the good quality rubber is available at a cheaper price. So that demand seems to be coming back into the market, also supporting the prices.
All right, Manisha, thanks a lot for getting us all of those details on rubber. Before we head into a break now, here's something that you, our viewers, must take note of. CNBC-TV18 and the National Stock Exchange have come together to promote investor awareness through a special campaign, Informed Investors, that empowers you to make the right decisions with your money. Now, as a stock investor, I'm sure you've seen multiple stock tips through SMS, emails, YouTube videos, telegrams, and several other social media platforms. But did you know that wrongdoers use these channels to pump and dump stocks? Well, I would advise you not to act on it blindly. A smart investor always conducts adequate research, analyzes risk, and consults only SEBI-authorized investment advisors to make an informed investment decision. In fact, you could go one step further and also report any unsolicited stock tips to the exchange. With that, we're going to get into a short break on the show now, but lots of trading ideas when we come back. Welcome back. You're still tuned into Trading Hour. The market, by the way, did briefly slip below that 17,800 mark as well. We're currently absolutely at those levels, but you are seeing the selling pressure only build. So do keep your eye on what's going on in the market. But right now, Nigel is standing by and he's going to put the spotlight on credit rating agencies. Nigel.
Well, there's been a lot of focus on banks and their credit growth in the coming year. And if the India capex cycle is going to recover, then corporate loan growth could show some bit of traction. And if that's the case, then maybe rating agencies could be in a sweet spot. Well, we had highlighted this fact on, this possibility actually on the editors' roundtable last Friday itself. So to give you a few more details, well, the market is dominated by 3 large players, and all of them are listed, whether it's CARE, CRISIL, as well as ICRA. Now, 3 of them put together have roughly, very, very roughly, close to around 75 to around 80% of the market share. But why is CARE higher in today's trading session, and why is the street a little excited out there? Well, in comparison to the other 2, well, it trades at relatively cheap valuation, so valuation comfort. Next up, cash in the books is more than 500 crores. I checked their last September disclosed numbers. It's at around 550 crores odd, which equates to around 28% of its market capitalization. Over the last few years, it's been a solid dividend-paying company, and those numbers should come up for you on the screen in terms of the dividend payout. And finally, the largest competitor, or the leader in the credit rating space is, CRISIL, and they have 8.85% stake in this company. That's CARE. So put all of this together, rating agencies could be well placed. CARE has a valuation comfort out there. And keep in mind, if business comes about, the single largest expenditure for them is employee costs. So operating leverage as well could play out. Just want to highlight all this for our viewers. Back to you.
Okay, thanks a lot for that. Very interesting. There are big moves coming into CARE. And as Nigel was saying in our earlier episode of Editors Roundtable, we had flagged off, Nigel had flagged off this particular, segment. So do keep your eye out on that. On to our special segment, Quarter Se Quarter Tak. Abhishek is here to tell us what are the expectations from the banking sector in this quarter. Abhishek, over to you.
Banking sector has seen one of the best loan growths in a while. The loan growth for the sector in Q3 FY23 has been around 17.5% YOY and about 4.2% quarter-on-quarter. So there has been business updates from few lenders which shows that private banks have witnessed strong loan growth momentum and they continue to take the market share away from the PSU counterparts. So RBI has been raising rates, so have the banks. Hence, one can expect the net interest margin of the banks to remain stable or improve on a sequential basis, given the fact that banks have been raising rates on the lending side in this quarter. So asset quality will not be an issue. We may see improvement in asset quality with lower slippages and better recovery rates. So large part of the slippages may come in from the restructured book, which is already known. Credit cost or provision for NPA divided by advances ratio will be lower on a sequential basis for majority of the players. Now, fee income can be the strong point this time around, given the fact that loan growth has been pretty strong. We may continue to see private banks investing in their franchise, which may keep their operating expenses on the higher side. So the cost to income ratio could remain on the higher side. PSU banks may continue to see improvement in their profitability and hence improvement in the return ratios as well. Time for mid-size and small banks to report better return ratios than their larger peers in terms of improvement this time around. Hence, we may see a record quarter for the banking sector in terms of loan growth, net interest margin, low credit cost and low NPAs. Some of the estimates that we have from Kotak Securities is that they expect SBI's NII growth to be around 20% YOY and about 4.5% quarter on quarter, while they expect net profit for SBI to grow at 55.5% YOY and decline a little more than 1% sequentially. For HDFC Bank, Kotak Securities estimates the NII growth of 20.5% YOY and about 5.5% sequentially. On net profit, they expect it to grow more than 18% YOY and a little more than 15% sequentially. For ICICI Bank, Kotak Securities estimate NII to be up 24% YOY and close to 3% sequentially, while profit growth is expected more than 32% YOY and around 8.5% sequentially. For Axis Bank, Kotak Securities estimates NII growth of 24% YOY and close to 4% sequentially, while they are expecting profit growth of more than 46% YOY and a decline of little under 1% quarter on quarter. Back to you.
Very interesting. Thank you very much, Abhishek, for that. The Nifty breached 17,800, has managed to climb just above it, but we're still down 90 points on the Nifty, with the Sensex lower by 330 points. Rahul Mohinder is now with us. He's from ViraTechIndia.com. Rahul, what have you made of the sharp fall that we've seen in the markets? And we're declining on our own. It's not that the global markets are under pressure today. So what is this inherent strength, weakness that we are seeing?
I think we've really been in a correction mode for a couple of days now. And, I've been citing this in my previous, week or two of appearances, that even if we keep drawing a quick comparison to September's drop of 7.5% from its peak, that would mean if we just had to replicate that drop from the current peak that we saw in December, that would mean we should be lower than 17,500. So what we're seeing is a correction within a slightly longer term bull market. A retest of the 200-day average can't be ruled out. And I've cited this point earlier too, which is nearer to 17,250. So I think ballpark is the trend will probably continue to be a little soft in the near term. One should be looking at trading the downside. And if you look at the immediate picture, a lot of traders have their hopes pegged, that the 26th of December low of around the 17,800 mark will hold. And, I think that's another fear that as we start breaking that level, we will see a little more pain come in. So in the near term, yes, I do expect a slide to about 17,680. That would be my first target, breaching which we'd probably go to about 450. So near term, that would be my target. What do you think will turn things around? We need to claw back above 17,950 on the Nifty spot if we want this market to really turn around. So within this entire setup, I think the weakest space looks banking. And, I'd like to probably put out a call or two on some stocks. So if you look at SBI at the current level too, I think we can clearly look at, good 3 to 4% downside coming on SBI. And my own sense is, the whole banking picture is what could upset the entire space. So a stock like HDFC Bank, the moment it starts breaching levels of 1580, I think we'd move to about 1540. So one could be trading short on that stock with a 1610 stop loss. And, if I look at other selective stocks which look weak to me, Reliance Industries, 2455 would be a first target. and breaking 24.55, I'd say a test of 24.20 is likely. Keep a stop loss of 25.05 when going short. SBI Life is one of those stocks that looks strong. And in the individual set, I think we could particularly see much bigger strength as we move above 1315. I would recommend buying with a 1260 stop loss and targets of about 1340.
All right, thanks a lot for that. Well, let's do one thing. Let's take a short break. Up next, we'll discuss the market fundamentals with Amit Khurana of Dolat Capital Markets. Stay with us.
Welcome back. 17,800 on the Nifty. The level that we are watching now will be the 26 December low of 17,774. We're still about 25 points away from it. We've not breached it, but we are precariously close to that level. The banks are underperforming today. The Nifty Bank is down 320 points. That's 3/4 of a percentage point lost on it. The big knock is coming in on Axis Bank. That's down 2.5%. Kotak Mahindra Bank is down close to about 1.5%. But there is a new update that's come in on the Axis Bank Max Life deal. We learned from sources that Axis Bank may propose to purchase Max Life stake at 85 rupees per share. Yash is here with the details. Yash?
So that's correct, Reema. So, I mean, just day before yesterday, Axis Bank informed the exchanges that they would be entering a revised agreement with Max Financial Services, and that would be to acquire the balance 7% stake in Max Life Insurance at a fair market value, which will be derived through discounted cash flow mechanism. Since then, there were, a lot of different kinds of understandings which are coming in terms of what could be that revised valuation for acquisition of that stake. What we've been given to understand from our sources is that Axis Bank is likely to propose a price of 85 rupees per share for the acquisition of that 7% stake in Max Life Insurance. And the rationale behind proposing that price to the insurance regulator is simply that the last transaction which happened in Max Life Insurance, where Max Financial Services, the parent company, bought about 5% stake, happened at 85 rupees a share, and that transaction did receive the insurance regulator's approval, which means that that price was accepted by the regulator, and hence Axis Bank is expected to propose that price to the insurance regulator for this transaction as well. As far as 85 rupees per share price is concerned, if that is to be taken as a price which gets accepted, if it gets accepted, then the total deal size for acquisition of that 7% stake increases to about 1,139 crore rupees. This is versus 429 crore rupees, which would have been the deal size at a price of 32 rupees per share. Also, the additional amount which Axis Bank will have to pay as per 85 rupees per share would be about 710 crore rupees. We've written to Axis Bank on this particular development, and we are still awaiting a response from the bank.
All right, Yash, thanks a lot for filling us in with all of the details and the latest on the Axis Max Life deal. But a quick look at the markets. We're still seeing severe selling pressure, and a lot of the stocks have, seen the cuts intensify. So Reliance has seen a sharp knock. A lot of the other banks that have come under even more pressure in the past few minutes. So take a look at Axis. You have ICICI, Kotak, all at the low point of the day. A lot of the auto names, so something like a Hero Motor, iSure, all at the low point. And in fact, a lot of the PSUs that we were speaking about earlier as well, NTPC, Power Grid, have taken a sharp knock. So a lot of stocks you're seeing at the low point of the day. But let's get a conversation going on the market. Amit Khurana, Head of Equities at Dolat Capital Market, joins us now to discuss the market. Amit, good morning and thanks for joining us. This is Pavitra. This entire past few days or this entire year, we have been talking about how there's been a little bit of a turn, right? We've been seeing a lot of volatility, of course, but we're also underperforming a lot of the bigger global markets. How do you read this? Do you think this is something that is likely to sustain, especially in the wake of what's going on in China and that entire reopening trade playing out there as well?
Well, yeah, thanks, Pavitra. Glad to be here. So I think India market very clearly was an outlier last year. We were probably one of the rarest of the markets which finished in positive territory, even if to the extent of 4% odd versus others going down by 15, 20, 30%. So I'm not surprised by the way the India relative performance is working out. In fact, we believe you could see that evolving further, and at least the first quarter or maybe a couple of quarters, we could be in a very, very tight range with no clear direction for India at large. But I guess that may also be the situation for largely the global markets, because right now the narrative seems to be recession and a declining inflation. If that does work out to be the case, then we guess that markets will probably take its own time trying to decipher new data points and especially the commentary from central banks. And then, of course, the corporate commentary that we get to hear in the earnings season. So it's a nowhere going market, so to say. And we guess that could be the situation we will have to spend at least a few months.
Okay, Rahul Sharma of JM Financial is also with us. Rahul, technically, how do you think the index is positioned? Because a lot of levels are getting, broken on the downside. You think the December lows is something that can hold, or is it just a matter of time before it gets taken out?
Yeah, hi, very good morning. So, yes, everybody wants to get out of this rut, and broadly the range being 17,800, 17,775 on the downside and 18,300 on the upside. Now, looking at the way markets have given up today, this is probably the fifth or sixth attempt that we are trying to break this key support area. And if it happens, the good thing is the momentum will be back into the market, at least on one side, which is downside. And we may see the Nifty heading towards the 200-day exponential moving average, which is approximately around the 75.50 mark. So my sense is I would be happy that if it happens, so that at least the range-bound choppy nature of the market at least gets us through. But the silver lining is there is leadership emerging from some of the sectors. So until the last few days, it was metals. Now capital goods have started showing strength. So at least some part of the market wants to be on the upside, and that is probably a silver lining which we would take. Ideally, in such a situation, the best thing to do is go along on sectors which look good, along with a hedge in the Nifty. So as far as sectoral outlook is concerned, I think it is metals and capital goods which look head over shoulders above everything else. And do that with a hedge on the Nifty with probably a 17,500 put for the monthly expiry. So that in case the breakdown does happen today, tomorrow, or whenever, we get to participate on the downside, and we are also able to make some money as well. So I think this is a strategy where we have to be cautiously optimistic, long on select sectors with a Nifty hedge to protect on the downside.
So you're recommending buying a 17,500 put on the Nifty. Rahul, we typically have a pre-budget rally. Are you completely ruling that out this time?
So I would say this is a very different kind of a market because the markets are not really expecting anything big on the budget side, at least as far as the price behavior is concerned. That is what the markets are suggesting. A pre-budget rally would be a difficult call to take as of now, considering the kind of data that we have. But one thing I would like to highlight is the retail positions in index futures are at a 3-month high, almost at a 3-month high, which means that retail is still long on the market. FIs are slightly short on the market, about 31,000 contracts versus 91,000 contracts by the retail. And we've seen in the last 12 months that retail has gotten it right more often than not. So I would like to wait and watch at this point in time, not be overly optimistic for a pre-budget rally. But as far as levels are concerned, I think one decisive close above 18,125 should see us ending this correction soon and momentum coming back into the market. So on the downside, the level has to be 17,775. On the upside, the level has to be 18,125 for a decisive move on either side.
Okay, got it. Rahul, I'm going to come back to you in just a minute for, more on the Nifty Bank and what you see over there as the key levels. But Amit, coming to you, do you see any pockets here which you still think are good places to hide, or you think that, in this kind of extremely volatile setup, they look slightly better positioned?
Well, I think there are quite a few pockets, but I think it's more bottoms-up driven from our perspective rather than top-down. So we clearly feel that staples eventually should be looked at very clearly. We also like banks. I think this correction in banks is probably more of a normalization of the superlative returns that we saw over the last couple of quarters from banks, frontline banks in particular. So we like that as a theme. In fact, one of the best balance sheets, one of the best asset qualities, and credit growth is pretty strong. So banks, staples, and even pharma. But having said that, I think again the individual allocations, bottoms-up allocations, are going to be far more important to figure out rather than the macro plays, at least for the first part of CY23. That's been our take on the broader structure of the market.
Okay. Any sectors that you would avoid entirely?
Well, yeah, I mean, we've been slightly more cautious on IT services, while the commentary from one of the first earnings that we saw was not that concerning. But I think the bigger take will probably evolve over the next quarter or so. because as the data deterioration works out in the global front, which we believe it will show up, whether the IT services, which is now projected to have high single-digit earnings growth for next year, whether that decisively goes towards low single-digit, I think that's the big picture call you've got to make. As of now, we believe high single digits will work out, and if it does sort of give us the confidence, then that is something that we would start looking at more actively. As of now, we are avoiding to take a look at it. Metals is the other one, and some of the data points are indicating a better pricing environment, which is a bigger driver of earnings for the sector. But at this point of time, we still feel there's some more time to go before we take a look at it, and hence avoiding that as of now.
Amit, Rahul was telling us that the capital goods space looks interesting from a technical point of view. Fundamentally, how is capital goods looking?
Well, we like the story. Very clearly, we are finding evidence that India manufacturing capex and overall intent to establish capacities in India has taken off meaningfully. Having said that, obviously, some of these franchises are quoting at very, very high valuations. And that has also corrected a bit. So structurally, we like the theme. We like some of the defense capex plays. And we also like some of the other manufacturing capex plays. So the choice is whether you want to play the OEM, the capex, so equipment manufacturers, or the end cycle and sort of entities, so to say. So we are preferring to play the second leg rather than the capex, the equipment manufacturers right now.
Okay, got it. Rahul, just one final question to you on the Nifty Bank. We are below that 42,000 mark, and this has really been the pain point for the market, right, over the past few days. Do you see this turning in the next couple of days, or do you think that this is going to be the trend for a while?
Yeah, so it's a tough one to take, frankly, the way kind of distribution we have been witnessing in the banking space. My sense is a down move until, say, 41,500, 41,400 should call for a reversal in the banking index as well. But the entire situation depends on how we behave at the Nifty breakdown point, which is 17,775. So if Nifty were to give this breakdown, Bank Nifty will find it difficult for sure. So far, Bank Nifty has been outperforming, has been holding its ground in spite of the volatility, uncertainty in the market. So I think time will tell whether we are able to do that. But my sense is there is a possibility of a bounce back on the cards, especially on the banking side, which could see us see the Bank Nifty testing 43,000 on the downside. So I'm more optimistic than pessimistic as of now. I think the levels are crucial, but let's take one day at a time, especially when the kind of volatility that we have at hand is at such an extreme.
Thanks a lot for joining in and giving us an update on the technicals, the fundamentals. Thanks, gentlemen, for being with us on the channel. Have a great day. Well, let's take a quick break. Here's an important information coming in for our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control Pro to get the full list. Welcome back, folks. It's still under quite a bit of pressure, and the bad part for the bulls is that there's no recovery at all. The Nifty is still down about 85 odd points. But the theme of the Auto Expo this year is sustainable mobility. Tata Motors showcased 12 cars, including 5 electric models, 14 trucks, including hydrogen fuel cell powered carriers. My colleague Parikshit Luthra caught up with Girish Wagh, the executive director of Tata Motors, on the sidelines of the expo. Listen in to what he had to say.
I think to address the challenge of climate change, the whole world is moving towards net zero greenhouse gas emissions, right? As a country, India has decided to be net zero by 2070. Logistics as a sector has a contribution of almost 18% globally in greenhouse gas emissions. Being in that sector and being leading OEM, we have decided to start this journey and in fact lead this journey. We have taken a target to be net zero greenhouse gas emissions by 2045 as Tata Motors commercial vehicles. Now, to progress this journey, it is going to be from the conventional fuels which we use today to natural gas to blended fuels, which is like flex fuel or biofuel, to battery electric and also hydrogen. And within hydrogen, I think there are two possibilities. One is fuel cell electric and second is hydrogen internal combustion engine. Now, it appears that as a country, we are going to balance our energy basket very judiciously as we move from conventional fuels to, say, hydrogen. So this necessitates, therefore, for us to have all these powertrain options in our portfolio for some time. And therefore, we have initiated development on all these technologies. We have showcased 14 concepts and products in this Auto Expo.
So let's start, sir, from here. These are 5 or 6 trucks that are parked here. Give us a sense of each of them and what they offer.
So what we have here is the Prima 55-ton tractor with hydrogen fueled internal combustion engine. So as I said, hydrogen is a good possibility, a very exciting possibility in commercial vehicles. And for long haul, heavy duty, where battery electric may not do the work, I think hydrogen is an option. Within that, I think, so we have developed this concept wherein you can also use the current intellectual property and infrastructure of internal combustion engines to a great extent.
So hydrogen on ice.
Hydrogen on ice. So, I think globally there is also talk of just transition. So hydrogen ice, in a manner of speaking, actually helps towards that.
Right. And this is the Prima E55S.
So this is the Prima with fuel cell. So we have both the options, the fuel cell as well as the hydrogen internal combustion engine here. And then on this side we have the battery electric.
Okay.
So even
this is pure EV.
This is pure battery electric. So even in heavy duty vehicles, for closed loop applications, say like tipping or construction, for mining and construction, this will be a battery electric tipper, right? And on the other hand, on the other side, what you see are our 2 new generation architectures. And the interesting part is that both these architectures are, that is Signa and Azura, are fuel agnostic. That means both these architectures can take in their lifetime all the powertrain technologies that I spoke about. Because it's a necessity that we do have this kind of a flexibility with us. So that's the range that we see here. Of course, at the rear, we have the buses. Even in buses, we have 2 buses. One is a battery electric bus on the left-hand side, and on the right-hand side is a fuel cell electric bus. Now, the one on the left-hand side is meant for the CSL Phase 1 tender that we had won, right? And this is the bus which will be delivered in Delhi and Bangalore, where we already have the order from the transport corporations. On the right-hand side, what you see is the fuel cell bus, wherein we won the first tender around 18 months back from Indian Oil, and we are going to supply 15 buses of fuel cell electric to them. So I think with this, even in buses, our portfolio will be having both battery electric as well as fuel cell electric.
Okay. And any of the battery electric trucks or the hydrogen ICE or hydrogen fuel vehicles that you plan to launch in the next 2 to 3 years? A lot of that depends on fuel availability.
So,
and how encouraged are you by the green hydrogen mission which has now been announced?
Right. So I think we will see good part of these vehicles getting introduced in next few years, right? So for example, the ones which will find it easier are of course battery electric, because the technology is developed there.
Charging infrastructure.
Exactly, charging infrastructure. I think the financials are becoming comfortable for financing these vehicles. So we'll see the battery electric ones coming first. In hydrogen, as I said, the fuel cell electric bus is actually going to be delivered and run commercially from the next financial year.
As a pilot?
Yeah. But it will be running commercially in the next financial year. So that's about fuel cell electric. But if you see in terms of horizon, as we stand here today, I think battery electric will come first, followed by, it appears that hydrogen ICE may come faster than the fuel cell electric. The reason is, hydrogen ICE is actually amenable for low purity hydrogen. Now, as you rightly said, the hydrogen mission which has been announced by government, we are very optimistic with that, because while we are making the vehicles and the technology ready, it is important that green hydrogen generation, transmission, distribution and retail infrastructure is also put up, right? So with the green hydrogen mission, we're quite optimistic that even that will come in place, which will ensure that, even hydrogen ICE will be a reality.
Okay. I would like to ask you, how much are you now going to be investing in the next fiscal on new technologies?
So, see, we have been investing around 1,500 to 2,000 crores per year in our commercial vehicle business. And I can tell you that every year, the percentage of spend which has been happening on new generation technologies or zero emission vehicles is actually increasing. Right. And here, the percentage that I'm calculating is only for the powertrain technologies. If you look at the vehicle, the architectures that I spoke about, they are anyway fuel agnostic. So leaving that aside, I think our percentage is consistently increasing and will continue to increase.
Right. My final question, sir, how do you see the growth in this fiscal so far? How do you expect to complete FY23 and how does the outlook for FY24 look?
So I think FY23 has been a good year for commercial vehicle industry after almost 2.5 years of slowdown, right? I think the industry started picking up from October of 21. This entire year till now, the 3 quarters have been good. We've seen almost 45% industry growth in terms of volumes. But within that, I think the buses which had declined the most during COVID period have come back strongly. Then medium and heavy commercial vehicles which declined the second max have also come back pretty well. Now looking ahead, therefore, we are quite optimistic that next year also this growth journey will continue. But of course, the percentage growth will go down a bit. Reason is the higher base. But we do look at next year also in an optimistic manner.
All right, that is the management of Tata Motors. They're sounding extremely optimistic on the EV push, talking about, the 4 new concepts that they've unveiled, saying that they're going to lead the EV journey and also very, very positive on growth in the coming year. So that is an interesting chat. But with that, we're going to get into a short break now. When we come back, the IT sector is in focus. We'll bring you all of the expectations from Infosys and HCL Tech.
Welcome back. We've breached 17,800 now. It's 17,788. So on the way down, it's more than a triple-digit loss on the Nifty. We're very close to breaking that 26 December low of 17,774. After that, if that level is broken with ferocity and we conclusively break that, the next level, the analysts are telling us, will be 17,500, which is where the 200-day EMA, exponential moving average, is positioned. So that will be a crucial level to watch if that level is broken. On the way down, you've seen Reliance Industries struggle. Reliance Industries is now at the low point of the day. That slipped close to about 2%. Axis Bank has been under pressure. UBS today came out with a note where they say that, perhaps Q3 FY23 is going to be peak margins for the banking sector. From Q4 onwards, we will start seeing margins declining. Infosys has lost close to about 0.7% ahead of its numbers today. Numbers will be out post market hours. And watch for HCL Tech as well. HCL Tech in the morning was holding up in the green, but from the day's high, HCL Tech has also slipped. So some of those gains have been given up in HCL Tech. Weak for the markets, still holding on to an important technical resistance. The second half of the trading session is going to be important. It's also the weekly options expiry today. It's a wrap in trading hour. Thank you for watching.